So what happened in 2008, the entire world economy was reset at zero rates. That was the debt jubilee, the Great Reset. They didn't forgive the debt, but they never paid it. They just rolled it.
Today, Real Vision CEO Raoul discusses his prediction for the last part of 2023 and believes that we're now months away from a catastrophic event. The collapse we're seeing of many countries' fiat money systems indicates that the situation is extremely dire. The recent inflation numbers are also a signal of these systems' instability and is surging as we speak. Raoul emphasizes that the repercussions are tangible, impacting people's ability to afford housing, food, and energy. And soon we'll see an inevitable run on the banks. He points out that not only is the economy spiraling out of control, but an abundance of money printing and misallocated investments is contributing to capital disappearance, which will be put on display as we start seeing more banking collapses in the months ahead. Let's get right into the latest interview with Raoul as he gives his market prediction for the last part of 2023. Don't forget to hit the like button and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
This is ongoing. And if I'm right in what I've laid out, the economy is slow right now, we're in recession, it will recover next year and we'll be in the sweet spot where the economy is recovering, earnings are coming back, so that's 2024, earnings are coming back, but inflation is falling and unemployment is rising. That leaves the central bank injecting liquidity in an election year where the government will stimulate. And that's going to create a very powerful boost for the markets. The central bank balance sheet usage will debase the currency. So you're looking for assets that could do the best in this scenario. So for me, the assets that do best is the exponential age, anything technology related, along with cryptocurrencies. And my chosen horse to back the most is crypto. We start to see a new economy arise, but we've got to get through this period first. And the only way that we're going to get through it is more cowbell. And I know that's upsetting for everybody. Everybody hates it. I get it. It makes the poor poorer, the rich richer. I get it. If you don't do it, you blow up everything, and that's the end for everybody. So they won't do that. So we don't play the cards we want to be dealt. We play the cards that are dealt with us. We have a central bank who's purposely trying to orchestrate a slowdown. And they've made that clear. They know the forward-looking indicators of inflation and unemployment are falling. And there's about $13 trillion to roll over. So there's the whole cyclical debt to roll over at higher rates and to monetize the interest payments. So at GMI, I developed something that I don't think anybody else had found, which was that we found that all interest payments were being monetized and that all of QE in the US, the UK, Europe, Japan were all the interest payments of the debt. And that they know what they're doing. So what happened in 2008, the entire world economy was reset at zero rates. That was the debt jubilee, the Great Reset. They didn't forgive the debt, but they never paid it. They just rolled it. So the idea is to get the interest rates as low as possible every time the debt payments come up.
Amid this fiscal tightrope walk, Powell discusses the economic indicators we're seeing, as well as the debt dynamics and the pivotal role of central banks in shaping the market in the last part of the year. With an air of urgency, he also highlights the mounting concerns encircling the colossal $6 trillion debt maturation slated by year-end.
And then what they do is they monetize the debt, because if not, you end up with too much debt and the markets can't take it, so the Fed takes it. And we're seeing that right now. Right now, we're exactly at that spot where the Fed is having to issue debt and the markets don't like it, so bond yields have completely disconnected from inflation, the business cycle and everything, because there's too much debt being issued and there's not enough liquidity around. And if that continues for this 13 trillion, you're going to blow up the bond market. But of course they won't do that, because what they will do is they are hoping that they can get inflation to undershoot as fast as possible, which I think is baked in the cake, as I showed earlier, unemployment to start rising, and then they can start monetizing the interest payments and they can start cutting rates. And so you can see from this chart that we're at the inflection point. So this Q3 23, the end of that is where we are, the end of this month. And then we start to come into Q4 and the balance sheet should start to come into play again. Will it be exactly right? Look, we don't know, but it's going to be directionally right. The first thing they'll do is stop QT. Then they'll have rate cuts, or they'll do rate cuts and then keep QT going and then stop it. Who the hell knows? Doesn't really matter. The point being is the liquidity cycle changes because they have to monetize this debt. There is no way they can issue all of this debt at 5% interest rates. It just blows up everything. And if they blow up everything, what do they have to do? More cowbell because they need to do yield curve control. It's all going to end up on the central bank balance sheet. That means liquidity goes up. It's showing you the path of future liquidity is going to go bananas in 24 and 25 and into 26. So that suggests to me very strong asset prices. This is why Yellen says there can't be another financial crisis. I do expect potentially some soggy period, maybe Q1, where this leading liquidity stuff slows down somewhat. Of course, we will see that. We can't keep screaming higher like we've been screaming higher. But I don't see anything that suggests that the market hasn't priced in the recession. I do an enormous amount of work on this. It's priced it in already. It's looking through the other side. Markets are forward-looking. As Stan Druckenmiller says, never trade today's news. You've got to trade 6, 12, 18 months into the future. That's where markets trade. That's what interests markets. They don't look at today's news. So trading on Nvidia's earnings today or Apple's earnings today is also nonsense. You need to extrapolate, forecast, guesstimate where you think they're going and place your bets accordingly. So for me, in this side of the argument, I firmly come down on the side of the bulls. And I've spent an enormous amount of time putting this thesis together. I was never naturally a bullish guy. I'm a macro cynic. But this is the most cynical expression of everything. Is yes, the great game is being played. The game is debasement. The game is to mutualize those interest payments amongst everybody by devaluing the currency. So if I know the game, I know how to play it. And for me, to play that game, I want to buy the longest duration assets possible that benefit from the debasement, so I don't get my losses mutualized.
Raoul Pal uncovers how changes in cryptocurrencies can send ripples effects through our wallets. Imagine a world where borrowing money becomes more expensive. Those cool credit card deals and car leases might not be as sweet, but it's not just about numbers. It's about fairness and how many things we can buy. Among the market noise, Bitcoin emerges as a rebel in the money world, shaking up old traditions. Powell points out that the everything code is like saying money is this invisible thread that's connecting it all together. With big banks being the guardians of balance, he says they're working behind the scenes to keep things steady, preventing financial chaos, but he believes the inevitable is coming. What do you think about the latest interview with Raoul Pal? And how do you think his prediction for Bitcoin, crypto, and the financial market plays out in the last part of 2023? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.